Good morning, students. Suprabhat, Sastri Akal, uh, Namaskar, and Vanakkam, Cho. I hope you all are good. And as usual, I believe that you are studying also very, very well. So again, I am C. Ankit Sharma, and we are here to discuss the provision regarding capital gain. This is our session 2 for capital gain. So if anybody who joined today and did not watch the last session, please do watch the first session. That will really help you to understand the provision clearly. So good morning. Wishes is from Sudhanshu. Good morning, Komal. Good morning, Sushil, Darshan, Bhumika, and Rajiv Kumar. And the query has been asked by Mr. Darshan. Sir, the commission or brokerage paid on acquisition of shares are to be included in the cost of acquisition. Yes, of course. Any commission brokerage paid at the time of purchase will be form part of the cost. And any commission, brokerage, etc. paid at the time of sale will be deducted from the consideration. Okay. Okay. Vishwanatha Reddy, good morning. Darshan asking, sir, please share the chart on the residential status that you showed in the revision session. Okay, Darshan. I will upload that chart also today after the class. Okay. So before starting today class, let's revise what we have studied in last session. Last session was generally the introduction part of capital gain, in which we discuss about the charging section 45, which says there must be a capital asset and there must be a transfer. Then we discuss the definition of capital asset as well as the transfer. So under capital asset, technically, all the assets are capital asset, but there are some exceptions like stock in trade, like personal effects, which are movable, but we have exception of the exception also. That there were 6 personal effects which were movable, but still they will be treated as your capital asset. Then agricultural land in rural area is not a capital asset, and then some specific percentage gold bond, special bearer bond, etc. They will also be not going to treat as a capital asset. Then we also saw the format to calculate the capital gain. That sale consideration, deduct expenses on transfer, then cost of acquisition or index cost of acquisition, and same improvement or index cost of improvement. Then we moved on to the definition of transfer under section 247, which explains us that transfer is a very wide definition. It does not include only sales, but exchange, relinquishment, extinguishment, conversion, compulsory acquisition, in a part performance acquisition of any building, and in respect of if you become a member of a society or a company, and if they provide you a building against the membership fees, then still it will be a transfer. Then we understood the meaning of long-term and short-term asset. Why that is important? Because in case of long-term capital asset, we should apply indexation concept. So to identify in the question that either we need to apply the indexation or not, we need to find out that the asset is a long-term or short-term. Some assets are after 12 months became long-term, some after 24 months, and some becomes that after 36 months. Then we also understood the concept of indexation and the formula to calculate the index cost of value. After that provision, I also discussed with you numerical also in short numericals, in which we discussed that how to calculate the capital gain and how to apply the indexation concept in our capital gain. So that was the recap. Today will be a new episode with you with a lot of talks, interaction. And before that, let's share the thought for the day. So the thought says, decide, commit, succeed. Decide, commit, succeed. These 3 words are very strong words. First of all, you have to decide what to do. Take your time. If you want to do something, do not do it in hurry. Think about it. and decide, yes, either you want to do this thing or not. Once you decide it, then commit yourself to do that. Commitment means you have to work for it. So if you decide to become a chartered accountant, then you have to commit. Commit means you have to give your time. You have to do certain sacrifice. You have that passion inside you to become a chartered accountant. And for that, whatever you need to do, you should do. So you need to commit that you definitely want to do something. Then you have to go through a specific process for achieving that goal. And in that process, you might have certain problems, uh, some breaks, a lot of issues can be there. But you should commit to yourself that I will achieve that target. So first of all, take your time to decide something, then commit yourself to that thing. That yes, I am going to do this. Whatever will be there, I will overcome that hurdle. So you have to commit yourself, and then if you are able to do that, you will be succeed at last. Later or sooner, you will achieve your goal, and that is definitely what I also believe. So if for certain thing you decide to do something, then first of all you need to commit. You have to do certain sacrifices for it. You have to give your time, etc. And if you are doing this, definitely you are going to success in your life. That was the thought for the day. Moving on to our MCQ now. So I hope you all are prepared for your MCQ test. Let's see who is actually there to give the MCQ test. If you revise the provision I have told you, I believe that you will be able to solve all MCQ, because today's MCQ test is very easy. Because we just discussed the basic concepts, nothing complicated. So there is a MCQ test which is very, very easy for all of you. Okay. So I believe you all are here for the MCQ test. Okay, Kavita is saying good morning. Diksha, good morning. Divyat is good morning. Kavita is saying we'll be waiting for the story. Do not worry. एक बार जो commitment मैंने कर दिया तो फिर कर दिया. Definitely, I will going to tell you a story also. And before that story, or except that story, whatever the provision we are discussing, that is also a story, because this is going to be your story of your life. When you will be chartered accountant, all these provision will become the story for your life. So please, everything is a story. Whatever we are discussing, the provision, the MCQ, etc. This is your story. This is your life story. So please be excited as well as for these kind of provisions also, as you are excited for the story. Who was she? She was Kavita. Okay. So moving on to our MCQ test. And generally I called it the moment of truth. It is to analyze yourself that yes, whatever you are doing, you are on the right path or not. So it is such ka samna, the moment of truth. So here is your first question, and let me tell you, this MCQ test is too easy to solve. Question number 1. Which of the following will be treated as long-term capital asset after 12 months? It's very simple, and I think you should not take much time to solve this and send your answer. So kindly do send your answer as fast as you can, like a flash. So the answer has been received, and Diksha is saying A, Vishwanatha Reddy is saying A, of course, Sudhanshu is also saying A. So I believe that all of you know the correct answer. Well done, everyone. The correct answer is, of course, A, listed shares. Here's question number 2. The goodwill of a business, trademark or brand name, right to manufacture, right to carry on any business or profession, tenancy right, route permit, or LUMA, they all are intangible asset. Okay, is acquired before 1/4/2001. The cost of acquisition of such asset shall be. So let's see. Divya said the answer is B in, I guess, question number 1. Divya, you might not be in the earlier class, so I requested to all of you, whenever you are sending your answers, kindly do write the MCQ number. So I'll be able to understand which question answer actually you are given. So MCQ 1 answer C. Sushil Kumar, no, the MCQ 1 answer, correct answer was A. Okay. Now Darshan is saying correct answer is A. Darshan is saying for question number 2. Vishwanatha is saying C. Again, Diksha is saying A. Sudhanshu A. Anisha Kola is A. And Kavita is also saying the correct answer is A. Remember, in the question it has been written that he acquired that thing. He acquired the tenancy right. That means he purchased it. He does not self-generate that. And I told you the concept says that even in case of goodwill of business or intangible asset, whether it's purchased or acquired before 1/4/2000 or after, it does not make any difference. So because the question says it has been acquired, that means it is not self-generated. So that's why the answer will be A, because it has been acquired, so that some amount must have been paid. So if it is self-generated, the cost is nil, but if it's purchased, then the purchase price will be your correct answer. So the correct answer is option number A. Third, those are giving correct answer. High five from my Wi-Fi. Next, which of the following is not a capital asset? It's again very simple. I have prepared 12 MCQ, out of which 9 we are going to discuss right now, and 3 belongs to the provision which are going to be discussed in today's session. So that 3 I'll be going to ask you either at the end of today's session or maybe in the starting of next session. That is those 3 are technically numerical topic. So which of the following is not a capital asset? You have to answer me out of these options. The correct answer is, of course, Mr. Sushil. Okay, you are still on question number 2. MCQ 2 correct answer was A. Now MCQ 3 answers, I am waiting. Okay, a lot of answer I have been received. The correct answer is, of course, C. Everybody give the correct answer. Well done. Personal movable assets technically are not a capital asset. Building is capital asset. Jewelry is also a capital asset. And D point, all personal assets. Like if you residing in your house, it's a residential property. So it's again a personal, but it is not movable. So you cannot say that all personal assets are not a capital asset. But only personal, those are movable, is treated as not a capital asset. So it's again very simple. Question number 3. Moving on to question number 4. Transfer does not include what? Transfer does not include what? Question number 4. Correct answer I am expecting. And the correct answer is, of course, D. Because extinguishment includes in the definition of transfer even sale and gift also. Gift is a kind of relinquishment. I have told you that relinquishment means waive your right on any asset voluntarily. That is, in simple language, we can say that is called gift. So every A, B, and C all are transfers. So the correct answer is D. Nothing is excluded from the definition of transfer out of A, B, and C. Fourth answer is B is written by Diksha. No, Diksha, it's a wrong answer. I have told you gift is relinquishment. And we discussed this provision also. Gift is transfer. But later on, it is exempted from the definition of transfer. But as per the definition of 247, it's a transfer. But as per exempted transfer, Under section 47, it is not treated as transfer. But basically, if as per the definition of transfer, you need to check, the gift is technically transfer. Okay. Fifth, the cost of acquisition of the right shares to a person who purchased the right to acquire the share from the existing shareholder shall be. Read it carefully and give me the correct answer. Question number 5. Tejas, your answer is wrong. Question number 4, correct answer cannot be B, it's D. I am asking what does not include as a transfer from the following. Sale is a transfer, of course. So I am waiting for the answer for question number 5. Okay, so the correct answer is C. In case of new shareholder who acquire right from the old shareholder and then purchase shares from the company, then price at which these shares are offered plus the amount paid to the person renouncing the right. That's the correct answer. In the diagram, I also discussed these provisions with the help of an example also in the last session. Okay. Now moving on to question number 6. So question 6 is, if goodwill of a profession which is self-generated is transferred, there will be what? If goodwill of a profession which is self-generated is transferred, there will be. So we are talking about personal goodwill, professional goodwill, which is in the nature of personal. If goodwill of a profession, in this question, we are talking about personal nature goodwill of a profession. So in this case, if it is self-generated, then there will be what? What is the correct answer? So question number 6, correct answer is of course B. There will be no capital gain. So if goodwill of a profession having a commercial nature, then it can be capital gain, etc. But if that is a personal nature, you cannot transfer it. And if you cannot transfer it, there will be no capital gain ever. 7. Rajat purchased a car for his personal use for 5 lakh in April 2022 and sold the same for 5 lakh 50,000 in July 2022. The taxable capital gain would be, you need to tell the taxable capital gain in this case. Question number 7 answer I'm expecting from all of you, and I'm expecting correct answer from all of you. It's again very simple. There is nothing difficult in these MCQ yet. Question number 7 answer I'm expecting, because car is a movable asset. It's in the personal nature. We just discussed that if there is a personal asset which is movable, then that will not be treated as capital asset. So in this example, even it is a gain, but because it's a personal asset and it's movable, so the answer is A. There will be no capital gain. We can say that it's journal. It's not possible that if you purchase something which is movable and personal for 5 lakh, then you can sell it in higher price. But if you are able to do that, still it's not a capital asset. So either it will be loss or it will be gain, where its chargeability is nil. So correct answer is A, that is nil. So those who is giving answer C is wrong. First of all, I always told you, you should read the question carefully. Then second step, you should plant your question into the provision. You have to put your question into the provision. So before that, you should recall the provision. So we are talking about car and as a personal asset. So car is a mobile as well as personal asset. So in that case, that is not a capital asset. So if something is not a capital asset, there cannot be any gain, etc. Okay. I was not expecting wrong answer in question number 7, but a lot of you have given me the wrong answer. So please read question carefully. I believe now it must be clear to you that why the answer is A. So next is question number 8. What is the cost of acquisition if a land is purchased on 1/4/2010 for rupees 10 lakh? Commission paid on purchase was 10% of purchase price and FMV on 1/4/2001 is 12 lakh. You have to answer it. This is a tricky question. Read it carefully and then only answer. Question number 8. Darshan is saying answer is C. I am waiting for more answers. Okay, so Anshu is saying C, Vishwanath is saying A, Kavita is saying C, Diksha is saying C. The correct answer is, of course, C. Why? In provisions, we discussed that land is falling. And of course, we discussed the provision of goodwill of business, goodwill of profession, then the shares concept, and the other asset. So this question fall under other asset case. In other asset, we have discussed that if it is purchased before 1/4/2001, then purchase price or FMV on 1/4/01 will be higher, will be your cost of acquisition. But if asset is purchasing on or after 1/4/01, so in our case, asset has been purchased on 2010. That means this concept is applicable. And this concept says simple, only purchase price will be considered. There is no concept of comparison it with a FMV. It is only doing if it is purchased before 1/4/2001. So in this example, of course, the second concept applicable, purchase price will be your cost of acquisition. And because we have paid commission on purchase, that is 1 lakh. Anything which is going to be paid at the time of purchase of any asset will form part of his cost of acquisition. So the correct answer will be, of course, 11 lakh, that is 10 lakh plus 1 lakh. I hope it's clear. Those are giving wrong answer. I hope it's clear to all of you now. Next is question number we just discussed. Question number 9. I guess, no, 9 you won't be able to solve. Okay, till 8 we discussed the question. After 8, there are question which is not the provision of which not yet discussed. So after discussing those provision, we will be able to understand question number 9, 10, 11, and 12. So I just told you either we are going to discuss these questions today before the end of the session or after today's session in the starting of the next session. So now moving on to our chart of cost of acquisition. I believe you must have gone through this chart and that might help you to understand the provision more easily. In this chart, this note number 1, I have already told this note number 1, which has been written in the left hand side. We are talking about this. So this note I just told you that in case of ordinary and right share, because in the diagram, the cost of acquisition has been written if it is purchased on or after 1/4/2001. So if in case of right share and ordinary share, if it is purchased before 1/4/2001, then cost of acquisition will be fair market value or purchase price, whichever is higher. So that I already discussed in the diagram. The second point is new. It is a separate provision which will be discussed in later concept. It's a special concept to find out cost of acquisition. It is a special provision for long-term equity shares. EOF is equity oriented fund bonus shares. If transfer on or after 1/4/2018 on which STT has been paid. So it has been written, refer page number 35 from notes part 1. So we are discussing notes part 1, and on page number 35, this point number 2 special provision, we will discuss in detail. So for time being, I have just written over here that you should understand that there is some provision left regarding the special provision to find out the cost of acquisition, which are going to be discussed later in this chapter at page number 35. Except that, if you have any query, you can ask me, or we are moving to our notes. So students, now cost of acquisition I have discussed with you from the chart presentation. There have been some important clarification also there, and now we have some more important clarification regarding the cost of acquisition provision. So it says where the capital asset becomes the property of the assessee before 1/4/2001, cost of acquisition means the cost of acquisition of the asset to the assessee or the fair market value of the asset on 1/4/2001 at the option of the assessee. So it takes generally whichever is high. So it is just discussing the provision we have already seen in the diagram, that if asset is purchased before 1/4/2001, then the cost will be FMV on 1/4/01 or the purchase price, whichever is higher. This concept does not applicable in case of goodwill of business, goodwill of profession, in case of bonus share, etc. For any other case, this is applicable. However, in case of capital asset, being land or building, or both, the fair market value of such asset on 1/4/2001 shall not exceed the stamp duty value. So if there is a building or land which we have purchased before 1/4/2001, suppose we have purchased some building on 10th May 1995 for 10 lakh rupees. And we are transferring, we sold this for rupees 70 lakh on 25th September 22. So the sale consideration is 70 lakh, but when we need to find the cost of acquisition, so provision will say the FMV on 1/4/2001 or purchase price, whichever is higher. So purchase price is 10 lakh. FMV will be given in question. So FMV is suppose is given in question is 12 lakh on 1/4/2001. So generally what we do, 12 lakh or 10 lakh, whichever is higher, of course. But this concept says that FMV should not exceed the stamp duty value of that property on 1/4/01. So if the stamp duty value of this asset is 11 lakh, then the FMV for the purpose of comparison we need to take is 11 lakh. Now whichever is higher will be your cost of acquisition, that is 11. Or in short, we can say that FMV at the time of 1/4/2001 or stamp duty value at the time of 1/4/2001, whichever is lower, will be treated as FMV for the purpose of conversion. So if the stamp duty value is not 11, it is 14 lakh, suppose 14, then we will take 12 lakh as FMV for the purpose of comparison. But if it is less than FMV, then we can take the stamp duty value as FMV for this provision. Next is goodwill of business, etc. Now it's an important provision. In all cases, if there is cost of improvement took place after the acquisition, then we also consider that cost of improvement if it is after 1/4/2001. Clear? But in case of goodwill of business, etc., the cost of improvement will always be nil. In relation to a capital asset being goodwill of a business or a right to manufacture, produce any process, any article or thing, or right to carry on business profession, the cost of improvement shall be taken to be nil. Okay. Land and building, non-depreciable cases. If it's a depreciable, it's a business concept, then it's a different treatment. But if you are transferring your building, which is non-depreciable, that means it is not used for the purpose of business or profession, then technically they are two separate assets. Why it's technically two separate assets for the purpose of capital gain? Because there might be question like this, that you purchased the land in 2005 for rupees 10 lakh. And then you start construction, which has been completed. The building construction is completed in 2011, and it took almost 40 lakh rupees. Now we are selling it. Then you need to sell it combined because it is the building which has been constructed on the land. So we are now selling land and building both for rupees 90 lakh. So for the purpose of capital gain, it should be mentioned in the question, how much is the land sale value and the building? So we need to calculate land and building, both capital gains separately. Why? Because the period of holding of both is separate. The cost is separate. We need to apply indexation, which is separate. So if it is given in question that the land part has been sold for rupees 60 lakh and the building part is for 30 lakh, then for 60 lakh, we need to solve the question separately. For the purpose of land, that means period of holding separate, etc. And for the purpose of building, the separate provision of capital gain should apply. So you should not try to solve it in combination, because in that case, there will be problem when you will find period of holding. There will be problem when you are going to find the cost of acquisition, index cost of acquisition, because the index will be in the denominator different. For the purchase, for the purpose of land, the 2005-6 index need to be used, and for the purpose of building, 2011-12 index need to be used. So this note is trying to make you understand that land and building are two separate assets for the purpose of capital gain. So if land acquired before 2 years and building constructed within 2 years, then we have to calculate separate capital gain for both assets separately, because in this case, land will be long term, because after 24 months, it becomes long term. And building part is short term because constructed within 2 years. So if in case of land and building, the consideration has been given separate and the both year purchase and cost has been given separate, then you need to calculate the capital gain separately. All provision will remain same. There is no difference. But the calculation should be separate. That will make your solution easy. Next, if any asset non-depreciable acquired on loan. Okay. Let me tell you like this. If you purchase land for rupees 40 lakh in 2005-6 and building construction for rupees 30 lakh in 2014-15. Now, if you are transferring or sell this asset in 2022-23 for rupees 140 lakh, out of which 90 lakh was land purpose and 50 lakh for building. So we need to calculate it separately. How? Now, concept and provision will be same. There is no change, but separate calculation should be made because for the purpose of period of holding, I need to take for the purpose of land, it's 2005 till 2022. For this, 2014 till 2022. Sale consideration 90 and this is 50. Less index cost of acquisition. So cost of acquisition for land is 40 multiplied by 331. But denominator index will 2005 and 6, which will be given in question, should apply. Same for this purpose, 30, 331, and the index for 2014-15, which will be mentioned in the question, should be utilized. So this is the process. You need to calculate capital gain separately for the purpose of capital gain purpose. The next note, it was saying that if you purchased any asset, for example, you purchased a building for rupees 90 lakh, for which you took loan of rupees 80 lakh. And for own yourself, you paid 10 lakh. So on this loan value, whatever interest will be accrued till the date of repayment. For example, in first year interest, we paid 1 lakh rupees. In second year, we paid interest 90,000. In third year, we paid 70,000. And after 3 years, we repaid the loan. So in this case, technically, we paid 2,60,000 as interest. So in the year of sale, when you sell this property and there will be capital gain, for example, you sold this property for 1,90,000. Then for the purpose of cost of acquisition, we take the cost 90 and apply the index concept. But for the purpose of interest, for example, this has been purchased in 2011-12. So we'll use 11-12 index over here for the purpose of cost, but whatever interest you are paying will be treated as your cost of improvement. Suppose this interest has been paid in previous year 11-12. This 90,000 has been paid in the year 12-13. And this 70,000 has been paid in the previous year 13-14. So this will be treated as a separate cost of improvement for each year separately. So 1 lakh into 331 and the cost of improvement index will be taken as 11-12, which will be mentioned in the question. Again for 90,000, 331 and 12-13 index will be used to find out the index cost of improvement. So 3 index cost of improvement will be deducted. In this case, so these 3 also need to deduct from the sale value. Then your capital gain answer will be arrived. So that is very interesting note. You need to remember this for your examination purpose. So this note number 4 is saying exactly what I have just told you. If any asset which is non-depreciable acquired on loan, then interest of such loan till the repayment will become cost of improvement and will be indexed if long-term asset sold. Okay. So we have completed the cost of acquisition provision with the help of the chart and as the clarification we discussed. Now moving on to our next section, that is section 47, and it says, its heading is very beautiful, cases in which transfer is not regarded as transfer. That means there is transfer, but we will not regard that as a transfer. So that is technically exempted capital gain. For example, As in the transfer definition, gift is included in the concept of relinquishment. So gift is a transfer. If in the examination it has been asked that whether gift is transfer, the answer is yes. But is it chargeable to capital gain? No, because it has been later on exempted. For the purpose of calculation of capital gain, this will not be treated as transfer. So for the purpose of definition, it is transfer. But for the purpose of section 45, charging section 45, for the applicability of the capital gain provision, this is not transfer. So we can say in simple terms, section 47 will explain the exempted capital gain, or we can say the exempted transfer cases. So these are technically exempted transfer, which will not result in any calculation for the purpose of capital gain. So there are almost 13 or 14 cases in which there will be no transfer treatment, and so we will not going to calculate capital gain. So for our purpose, these are good, because if in the question it has been written any case out of these 15, then what we need to answer, we just need to write it down that that is not a transfer. There will be no capital gain. Okay. So first is distribution of asset at the time of partition of HUF. Distribution of the asset at the time of partition of HUF. So HUF is Hindu undivided family, and you have already read the provision in basic chapter 1. But under a Hindu undivided family, and that Hindu undivided family at the time of partition, suppose first case regarding partition of HUF in case of Hindu undivided family. So the concept says that if there are Hindu undivided family, in this family father and his 3 son S1, S2, S3 and daughter D1 is there, and there is 5 similar building in the HUF. Now father decided to run partition in the family, and he transfer all these one house to each of his son and daughter. All belongs to the father, but they decided, or all belongs to this HUF, and now the HUF decide to part with these assets into the members. So technically nobody is going to charge anything from the member. This is free of cost, because technically these property belongs to these owner. They have actually taken these property and create an HUF. So at that time they did not ask anything HUF to pay. In the same way, now HUF is distributing these property into the members at the time of partition. So there is no technically consideration has been taken from the members. So that is regarded as exempted transfer. Why government did so? Because at the time of partition, we did not charge any consideration. HUF will not charge any consideration from any of the members. So sale consideration for the purpose of capital gain will be 0. But there will be cost. So if in this case we try to calculate the capital gain, there will always loss. So department does not want that loss, because you might going to set off this with the income. So that's why partition of HUF is exempted from the definition of transfer. The second case is regarding gift. It is also same case. If there is any gift, will, or irrevocable trust. Irrevocable trust means if you donate your asset to someone. Irrevocable means which cannot be reacquired. Once you give something, if you cannot reacquire it, that is called irrevocable. So technically will, gift and irrevocable having same treatment. In all of these cases, again, there is no sale consideration and cost need to reduce. So there will always loss. So this loss also is not going to be treated as transfer. So we have discussed the definition of transfer that gift is transfer. But I've told you that later on it has been exempted transfer. So this is the concept. It has been exempted from the definition of transfer. So in the all cases, what we are going to discuss under section 47, the same concept applicable in almost all cases. There might arise loss. That's why department try to exempt it transfer in all these cases. So distribution of asset at a time of partition of HGF is an exempted transfer. If it is given in question, you need not to calculate anything. You just need to write it down. It is transfer which is not regarded as transfer. No capital gain. Second, transfer of capital asset under a will, gift or irrevocable trust. I just told you, irrevocable trust means donation which cannot be taken back. The third is in case of amalgamation. Let's see what amalgamation wants to tell us. In case of amalgamation, for example, there is A Limited and there is B Limited. A Limited is going to be amalgamate into B Limited. So one will be amalgamated company, one will be amalgamating company. Okay. So can you tell me which should be treated as amalgamating company? One should be treated as amalgamated and one should be treated as amalgamating. So let me see how many of you know that which is amalgamating company. Okay, tell me which is amalgamating company in this example, whether it's A or it's B Limited. Okay, Rajiv Kumar is saying, sir, I am using BOS app. I am not getting from where to download notes. Even I do not know from where to download notes from BOS app. But I've explained that it is available on the site and I've explained the whole procedure in the last session. Let me tell you again, you should go to the icai.org website. There is a section, the student section is over there. You need to go to the BOS knowledge portal. They will ask for your CRO number and your date of birth. You have to put your date of birth and CRO number. When you log in that, there will be a multiple option there, and in one option there is notes has been written down. Click on that section. After that, there's multiple faculty name also given. You need to search my name, and when you search my name, you will find all the notes are there. So kindly go there and please download the notes. Varsha, frequently session is disturbed due to net issue. Might be at your part. My part, it's clear. Everything is clear. Kavita is asking something. Let me answer you. After I need to know the answer. In case of A Limited and B Limited, which is amalgamating company? Kavita, wrong. Amalgamating company is A Limited, not B. B is amalgamated company, which is amalgamated company. So amalgamating company is A Limited. Clear? Now, in case of amalgamation, what generally transfer? There is two kinds of transfer take place. In case of amalgamation, A Limited transfer all asset to the B Limited. It's a rule under amalgamation. All the asset, all the liability should be transferred from amalgamating company to amalgamated company. So we do not need to do anything with the liabilities. We are talking about the asset. So in case of amalgamation, transfer of asset from A Limited to B Limited. So that is a transfer and transfer of an asset. So capital gain concept arise. And second thing, all the shareholder, because now A Limited is going to end. So all shareholder of A Limited will receive now share of B Limited. Because A Limited is going to end, so there will be no remaining share of A Limited. So the shareholder of A Limited is going to get the shares of B Limited in case of amalgamation, in exchange of their shares of A Limited. So again, there is shares and exchange also. So again, capital gain applicable because there is asset and transfer. There is asset and transfer. So technically, under amalgamation, there is two transfer involved on which capital gain concept applicable. One, all the asset of amalgamating company is going to be the part of amalgamated company. So there is a transfer. So for this purpose, section 47 say, yes, there is capital asset, yes, there is transfer. But now this is exempted transfer. You need to calculate any capital gain. You need not to calculate any capital gain if condition number 1 fulfill. It is that the new company, the amalgamated company, should be an Indian company. So if B Limited is an Indian company, then all the asset transfer from amalgamating to amalgamated is exempted from the concept of transfer. Okay. Now under section 47, the shared exchange is also exempted, provided two conditions fulfill. Amalgamated company is a new Indian company, of course. It should be an Indian company, same condition. And the second condition, only shares will be provided. Only shares will be provided against shares. For example, in case of amalgamation, Mr. X is the shareholder of A Limited, having 1000 shares. Rate of exchange of share is 2:1 in the amalgamation. That means against his 1000 share of A Limited, he will get 500 shares of B Limited. So the concept says only shares will be provided against the shares. So now 500 shares need to be received by Mr. X against his A Limited 1000 share. But what happened if B Limited provide 400 shares and money for 100 shares? So if money or any other asset involved in exchange of shares, then this capital gain will not exempted. It is going to be taxable. So only shares will be received against the shares. So if 500 shares, 400 shares has been given, and for 100 shares, money has been given to Mr. A, then that is not exempted. That is going to be taxable. So exemption will run in second case only if both conditions fulfill. Amalgamated company is an Indian company and only share will be transferred against shares. If there is any other consideration, then this will going to be taxable. But there can be a genuine problem. If Mr. A having 1000 share of A Limited and now B Limited share will be allotted to him due to amalgamation, but the ratio is 3:1. So that means now we need to give him 333.33 shares. So this portion can be given as shares, but this fraction, that means 0.33, cannot be provided in the share form. So for this, he paid money. So in case of fraction of share, if money has been paid, that is allowed. So this transfer is still will be exempted. So only in case of fraction of share, money can be paid, but if there is money as a consideration other than fraction of share, then that capital gain is going to be taxable. So point number 3 and 4 deal about this, what we just discussed. Transfer in case of amalgamation by amalgamating company to amalgamated company, provided amalgamated company is an Indian company. So 3 is talking about transfer of asset. 4th is talking about the shareholders share exchange concept. So any transfer by the shareholder in the scheme of amalgamation of the shares held by him in the amalgamating company, provided amalgamated company should be an Indian company and transfer is made in consideration of allotment of shares in the amalgamating company. No part of consideration will be other than share. Consideration other than share is only allowed in case of fraction of shares. I hope it's clear. This is an example. Mr. M held 2000 share in company ABC Limited. This company amalgamated with another company during the previous year, 31st/3/2023, under the scheme of amalgamation. M was allotted 1000 shares in the new company. The market value of the shares allotted is higher by 50,000 than the value of the holding company ABC Limited. The assessing officer proposed to treat the transaction as an exchange and to tax 50,000 as capital gain. No. Under amalgamation, this cannot be taxable. Just happened. Is there any video issue, Mr. Ashok? Because okay. So in this case, because the amalgamation is exempted, so in this case, it cannot be treated as transfer. Next, almost same concept like amalgamation in case of holding and subsidiary. So transfer of a capital asset by holding company to subsidiary company or vice versa, provided transferee company is an Indian company and holding company holds entire share capital of subsidiary company. So just like in case of amalgamation, if there is a transfer of capital asset from a holding to a subsidiary or vice versa. So again, this is not going to chargeable to tax if two conditions is fulfilled. First, the transferee company, that means if holding is receiving from subsidiary, then holding should be Indian company. And if subsidiary receiving it from a holding company, any asset, then subsidiary should be Indian company. And holding holds the entire share capital of subsidiary company. The word is entire share capital. Entire means 100% share capital, equity, as well as preference. Both must be with holding company. So if there is a holding subsidiary, you can be a holding company holding on 51% also. But if you need to exempt it the capital gain, then only those holding company and subsidiary company transfer is not treated as transfer if holding company holds the 100% equity as well as the preference share capital of that subsidiary company. Okay. Point number 6, any transfer of a, let me take the queries first, then we will move on to point number 6. Okay. So Kavita was asking income of 4 lakh from royalty on patent registered under the Patent Act received from different resident clients. No TDS was need to be deducted by any of the clients. Okay. He received 3 lakh from a debtor which was written off as bad debt of 15/16. Amount due from the debtor which was write off as 5 lakh, out of which tax officer had only allowed 3 lakh as deduction in computing the total income for assessment year 16/17. Explain the treatment. You inserted the PGBP question in our capital gain queries. Okay, fine. Let me tell you. Income of 4 lakh from royalty on patent registered the patent received from different resident clients. No TDS was needed to be deducted by any of the clients. So in this case, 4 lakh is not a business income. It's a part of your income from other sources. Fine. So this 4 lakh will be form part of your income from other source, as well as there is a specific deduction also regarding that under section 80 QQB 80 RRB regarding this kind of royalty on patent. So that is going to be discussed when you will be able to read the deduction under section 80 RRB. So this is a kind of wrong question. Point number 2, I can explain to you. If you receive, that's the same concept of unrealized rent recovery as per house property. So 3 lakh has been received from a debtor, out of which 5 lakh write off as bad debt, but officer has only allowed 3 lakhs. So in this case, only 1 lakh is going to be taxable. There is a concept in case of recovery that if you receive 5 lakh, if you have written off your bad debt as 5 lakh, out of which only allowed was 3 lakhs. So 2 lakh was which bad debt had not been recovered. So if any bad debt which has not been allowed as deduction by assessing officer, in this example, 5 lakh was your bad debt, but only 3 lakh has been allowed. So 2 lakh was the bad debt which has not been allowed as deduction. So that 2 lakh will be deducted from the amount recovered in the future first. So in the future, you recovered 3 lakh. So first of all, we have to deduct those amount which has not been allowed as bad debt by a assessing officer. So from 3 lakh, 2 lakh need to be deducted, then balance 1 lakh will be your PGBP income. That royalty part will be going to the income from other source. That question might be sent someone, some friend or etc. to ask in the query session, I guess, because it's not been written by you. And please, whenever somebody else is going to ask any question, or if you need to ask any question, you should see that which is related to your query session, because this royalty question is not part of your questions of PGBP yet. The second part is already relevant, but that also has been asked by someone else, or you might copy it from somewhere else. Okay? Still no issue, you can ask me anything. But please ask those queries which is related to our topic, what we have covered only. Okay? So those who is hearing this answer, this is a query from Kavita. You need not to bother about it. That's a different kind of query. Okay. Next query is Mohammed K. What if transfer of share as gift when it received under ESOP? Transfer is exempted completely. Whatever you are, gift is exempted. Whatever you have received from anything, if you are gifting it to someone at that point of time, that is exempted capital gain. What is fraction? Fraction means subpart in decimal, like 333.33. That is called fraction, which is not in absolute form. Okay. KR Maring asking, sir, can you explain a scheme of demerger? I can explain anything. But demerger, the scheme of demerger, the scheme of amalgamation, that is not part of this capital gain topic technically, because that's a different topic. So we have provision regarding demerger and amalgamation, but for capital gain, we just need to see the implementation, because if we go into the concept of demerger and the concept of amalgamation, so we have a short of time. Yes, but I can promise you one thing. You can ask me this demerger concept and amalgamation concept if we have time. So we have now 3 more sessions after this for capital gain, and I believe we must have some time. So kindly try to ask me this question, Mr. Maring. If we have time, I'll ask in the query that if you have any query left, then at that time you can ask me. I'll try to explain it in short, of course. So now point number 6 is there, which says, any transfer of a capital asset being any work of art, archaeological, scientific, or art collection, book, manuscript, drawing, painting. We are talking about the antique thing. So if you transfer any of these kind of antique things to the government, university, national museum, national art gallery, or any other public museum, then this is exempted from capital gain transfer definition. So if I am having some antique things, like this calculator belongs, this is antique, suppose, okay. So if this antique thing I am going to transfer to the government museum, etc., then there will be no capital gain. That will not be treated as your transfer, okay. Next is any transfer of FCCB. FCCB stands for foreign currency convertible bonds. Foreign currency convertible bonds. It's kind of like Indian bonds. So if we issue our bonds in India, bonds, debenture and bonds. So if we issue bonds in India, these are called normal bonds, etc. Or if we issue convertible bonds in India, we called it convertible bonds. So suppose if any company issue is convertible bonds outside India in some other country. So what it be called? Foreign currency convertible bond, because these need to be issued in foreign currency. Of course, if you are going to issue them in another country, that country currency will be the denomination of these foreign currency convertible bond. So FCCB is nothing. If you know what is the convertible bond, so those convertible bonds issued in India, these are called convertible bonds. And if these are issued outside India, they will be called foreign currency convertible bond. It's a kind of a security. Okay. Then ADR stands for American Depository Receipt. Like if you are issuing equity shares in India, we will call it equity shares. But if against that equity shares, what is issues in India, against that equity share, if you issue any depository receipt in America against that equity share, we are not issuing equity share in America. We have issued equity share in India, but on behalf of that equity shares which have been in India, we are technically issuing depository receipt in America. That will be called American Depository Receipt. So company decided to issue 100 crore of equity shares. They are not distributing these equity shares in Indian public. They decide to issue 100 crore equity shares in India, but it's not going to allot in India. And against this equity shares, company decide to issue depository receipt in America. So that is called American Depository Receipt. And if it is other than America, in another country, we will call it GDR or Global Depository Receipt. So in the simple word, if you issue convertible debenture outside India, it's called FCCB. And in general, we can say if you are issuing your equity share outside India, in America, it's ADR. Other than America, it's Global Depository Receipt. So equity shares and ADR, GDR having same nature. All benefits are same except the voting right. So only voting right is with the equity shares, but ADR, GDR holders cannot raise any voting right. They can receive bonus, dividend, etc., but they cannot have any voting right. So if somebody is going to ask you what's the difference between ADR, GDR nature and equity share, the voting right is the main difference. We call it Euro issue also, FCCB, ADR, GDR. In combination, if we need to call it, we can call it Euro issue. Or we can issue rupee denomination bond made outside India by a non-resident to another non-resident. Now understand what is actually happening. It says if you are having any FCCB, if you are having any ADR, GDR and rupee denomination bond, they all are going to issue outside India. So they all have been issued outside India, and Mr. A and Mr. A, who is a non-resident, purchased them in 2021. And now Mr. A non-resident, is going to sell it to Mr. B, who is also a non-resident, in 2023, and they both are outside India. So the concept says if you are transferring what? FCCB, ADR, GDR or rupee denomination bond. If you are transferring these assets outside India and the buyer and seller both are non-resident. So technically government of India cannot control this transaction, cannot control the buyer and seller because they both are non-resident. They both are outside India. The transaction has been undertaken outside India. So in that case, government say this is exempted from capital gain of India. That is the definition of transfer, and transfer definition say this transaction will not be termed as transfer. So that is exempted transfer. Okay. Next, the provision we discussed about the amalgamation, that in case of amalgamation, there is a capital asset transfer from amalgamating company to amalgamated company. That is exempted if amalgamated company is an Indian company, and share transfer also exempted if amalgamated company is an Indian company and only shares has been allotted against shares, except in case of fraction. Same point number 8th and 9th in applicable, copy paste applicable in case of demerger. So if there is any demerger, then again the asset need to be transferred from demerged company to resulting company. That is exempted if resulting company is a Indian company. And again, share transfer also happen in case of demerger. That is also going to be exempted if the resulting company is an Indian company and only share has been transferred against the shares, except in case of fraction of share. Exactly same provision is amalgamation and demerger, two case, same copy paste. In even 9th point, it's talking about the transfer of shares. Again, fraction has not been written over here, but the concept is same. If there is fraction, you can pay it in cash, etc. Other than fraction, there must be allotment of share in exchange of shares. So we have discussed the concept of HUF 1, then gift, etc. second, two amalgamation concept, that means 4. One is holding subsidiary 5, museum concept 6, FCCB, etc. 7, and now 8 and 9 is demerger. So we discussed total 9 concept of exempted transfer till now. Next is any transfer of capital asset being a government security. This is almost resembling to point number 7. In that case, there were FCCB, ADR, GDR, and rupee denomination bond. Now we are talking about any government security by a non-resident to another non-resident outside India. Same concept. Any redemption of sovereign gold bond under the government scheme by an individual will be exempt also. So these 11 points we technically discuss. 11 points. We just discussed the 11 points, which is transfer but not regarded as transfer. So technically, if you are thinking, and if I am going to ask you one very simple question, that what do you think? These 11 points will be our theoretical concept in the examination or will be asked as a numerical question? These 11s are exempted transfer. So if I'm going to ask you that whether they are going to be asked in examination as numerical or as theoretical, what do you all think? Tell me. This question will be asked as a theoretical or numerical. These 11 points will be form part of 11 theoretical or numerical. What do you think? So technically, you might be thinking that it will become as a theoretical. But let me tell you, the probability is to ask it is as a numerical question always. Why? Because this is one of the most important numerical question in the capital gain topic. Or we can say this is the first quite complicated, or we can say new kind of capital gain question. Till now, we are seeing that question of capital gain is very simple. We just need to find out the period of holding, then sale consideration in question, then index cost of acquisition or index cost of improvement, and we have the answer. But this is the first new kind of numerical solution in case of capital gain. How? Let me explain it to you. The question is like this. Suppose there is Mr. A. He purchased a house in 2002, 1st April 2002 for rupees 20 lakh. Clear? This house has been gifted by him to his son on 10th August 2015. At that time, the fair market value of the house was 70 lakh. Clear? His son done some cost of improvement for rupees 2 lakh on 1st April 2017. Son gifted this house to his brother on 1st July 2020. At that time, fair market value was 110 lakh. Brothers sold this house for rupees 200 lakh on 1st October 2022. So now examiner will ask you to calculate capital gain in this case. So if you will see, this transaction of gift is exempted transfer. So in the year when Mr. A transferred this house to his son as gift, so there will be no capital gain chargeability as that was exempted capital gain. So no capital gain concept will be applicable over here. Son gifted it to his brother. So these 11 transactions, what we have discussed, having the same treatment. If I have write it down other than gift, that son transfer this building to his brother at will, or transfer it as a irrevocable trust, or if this is a question of amalgamation, does not matter. The concept will remain the same. The solution part will remain the same. So there will be no capital gain in this year. Again, gift, will, etc. All these 11 cases, any cases you can put it over here or it over here. The solution will remain the same. For example, A Limited is converted into B Limited and B converted into C Limited. And now C Limited is sold this asset. Same concept. There is no problem in solving all these 11 questions with the same concept. Again, in this year also, there will be no capital gain because again gift. But yes, in assessment year 23-24, we need to calculate the capital gain in the hands of assessee. So who is the assessee? Assessee is his brother. For example, name is C. Assessee is that person who get the money. So A is not the assessee. Son name we suppose B, not the assessee, but brother name is C. So who is receiving the money will be called the assessee. So computation of capital gain in the hands of Mr. C for assessment year 23-24. But this is special transaction. So now when we will try to find out the period of holding, in generally what we do, we take the period of holding from the date of purchase till the date of sale. So in normal question, the period of holding will be this. Because Mr. C get this property in July 2020 and sold it on October 2022. But because in these 11 transactions, the special provision has been made. It says that those transactions which are not regarded as transfer, those time period will be assumed as 0. So technically, gift from Mr. A to B is irrelevant. From B to C is irrelevant. So these time period will be excluded. So for the purpose of period of holding, it says the previous owner time period will also be included calculating the period of holding. So if any transaction has been executed having these exempted transaction case, then the time period of previous owner will also be included calculating the period of holding concept. So the period of holding B will also include, and B preceding transaction from Mr. A. So that is also included. So period of holding will come from year 2002 till 2022. So that means it's a long-term capital asset. So for the simple purpose calculation, I can tell you the transfer will be assumed that asset has been transferred by Mr. A to A on 2022. Technically, C sold this. But for the purpose of calculation, income tax assumed, suppose because C is not the person who pay for it. C received the asset by that mode, which is exempted transfer. So suppose Mr. A transfer this asset in 2022 directly, because this is technically for the purpose of income tax is 0. A transfer to B is 0, B transfer to C is 0. So technically you can assume that A transfer this asset in 2022. So that's why the period of holding is running from 2002 till 2022. Now, interesting thing, sales consideration, of course, 200 lakh. Technically, Mr. C get the money, but for the purpose of solution, we are taking period of holding. We need to take the period of holding from Mr. A point of view because he was the real owner who actually spent the money to purchase this property. And now you can see why we are saying this, because when you are going to solve index cost of acquisition concept, the cost of acquisition of C cannot be taken because there is no cost involved by Mr. C. Again, cost of B also 0, exempted transfer. Cost of acquisition of A will be taken in this place. So if you need to solve this question, here is the trick. What is the trick? That assessee name is only C. For the purpose of assessee, the name should be C. But for all other purpose, like to find out the period of holding, you should understand the asset has been sold by Mr. A directly. So period of holding from Mr. A till now, the period of holding, the cost of acquisition also from Mr. A need to be taken because there is no cost involved by B and C except the cost of improvement of B that we are going to take. So 20 lakh need to be solved. Now here's a problem. 20 lakh multiplied by 331. Denominator says what? Denominator says the formula says the previous year index has been taken in which asset held by assessee. Now this is a problem. As per the formula, we need to take the denominator as per assessee. Suppose you can see it, that period of holding we are taking as per Mr. A point of view, who is the previous owner. The sale consideration has been taken as per Mr. A point of view, which is 20 lakh. But as for the purpose of denominator, we should take Mr. A index of 2002 and 3. But the formula says something else. It says that for the purpose of denominator, formula says that the assessee value should be taken. Assessee. And the assessee in this question is C. So technically, as per the formula, we have to take the C value, which is as he received the asset in 2020. So financial year 2020-21 index need to be taken over here, then the value here, and we will find our capital gain. I'll solve the question detail, just trying to make you understand with this example that what is the concept of period of holding and cost of acquisition. Remember always, assessee will remain C always. The person who got the money, that will remain the assessee always. Remember this point, 1. In case of all 11 questions, assessee will remain C. Then period of holding will be always taken from the point of view of previous owner. Remember, this is the second important concept in case of these kind of 11 questions. Then third important question, the cost will be taken as per the previous owner. And the very important and fourth, that the index of assessee need to be taken, and that is Mr. C, not Mr. A. So in solution, you need to find these 4 points, or you need to write down these 4 points very, very carefully. Assessee is C, period of holding and cost of acquisition of A will be taken. But index of the assessee we need to take. Conceptually, or we can say practically, the index of Mr. A should apply. Because we are taking period of holding from the point of view A. We are taking cost of acquisition from the point of view of A. So we are doing in the numerical topic solution everything from the point of view of previous owner. So index should also be from A point of view. But we can't help it because in the formula, that is denominator written that the previous owner word is not, that is assessee cost of assessee index should be write down in the year asset held by assessee. So assessee C. So we have to take the index of Mr. C, which is practically not correct because period of holding and cost need to be taken from the point of view A, but index should be taken from the point of view of C in this example. So this is the provision, and you can see that. Clarification for all above 11 cases. Do not worry, I will solve more numerical question in detail for all these 11 transactions. First of all, I need to just communicate to you that period of holding and cost of acquisition will be taken in these cases from the point of view of previous one. In all the above case, capital gain will be exempted as transaction will not regarded as transfer. But in above cases, when assessee will transfer, like when you A transfer to B, there is no capital gain requirement to calculate. When B transfer to C, no cap gain. But when C, who is the assessee, is going to sell this, then we need to calculate. When assessee will transfer the asset in normal case, in that year, capital gain will be liable to charge as follows. So previous owner, Mr. A purchased in 2012 any asset for rupees 10 lakh. He gifted this to Mr. B. So Mr. B is the current owner. So when Mr. A gifted this to Mr. B in 2016, there will be no capital gain concept applicable, but B sold this to C in January 2023 for 32 lakh. So now in this case, capital gain need to be chargeable because this transaction is exempted. No capital gain requirement. But this is taxable because now he is sold this to Mr. C. So because Mr. B sold it to Mr. C, so for assessment year 23-24, January 23, it has been transferred. So for assessment year 23-24, we need to calculate the capital gain. So who is the assessee in this case? B, because B sold asset to C. Now, if I'll ask you, what is the period of holding? Period of holding will be from now 2012 till 2023 because period of holding will be as per previous owner. That is Mr. A. Now, what will be the sale consideration? 32 lakh less index cost of acquisition. So, what will be the cost of acquisition? Cost of acquisition of Mr. A need to be taken. That is previous owner, 10 lakh into 331. And if I'll ask you the index of which year need to be taken? Now the problem arises, we cannot take it of the previous owner, that is Mr. A. We need to take it from the point of view of Mr. B, that is indexation of 1617 will be applied to calculate the capital gain. I hope it's more clear now. Okay. So it has been written for Mr. B, capital gain period of holding will also include period of holding of previous owner, that means from 12 to 23, and cost of acquisition will be 10 lakh as the cost to the previous owner. Index for normal case of Mr. B, assessee will be taken, but now somebody say it was wrong. I just told you that yeah, it is wrong because period of holding we are taking from A point of view. cost we are taking from Mr. A point of view, so the index should also be taken from Mr. A point of view. But as per the act, as per the formula, it has been written that assessee asset is first held by assessee. So assessee index need to be taken as we took in the above example. But there is a case of Manjula J. Shah. Assessee went to the court, appealed it, and say why the index of assessee need to be taken. They say if the cost has been taken from the point of view of Mr. A, if the time period has been taken from the point of view of Mr. A, then the index should also be taken from the point of Mr. A. And yes, we have the judgment in the favor of assessee. And now, as per case Manjula J. Shah, the index of Mr. A will be allowed in place of assessee. So, if we applying provision as per Manjula J. Shah in the above example, then cost will be, of course, 10 lakh. Then 3331, sorry, cost was, I guess, 12 lakh. Just a second. Cost will be 10, okay, correct. So in the example, cost was 10, 331, and we generally took the assessee, Mr. B index. But as per Manjula J. Shah, now we will take the index of 2000, 12, 13 to solve the question. And that is beneficial to the assessee. You can see the 1213 denominator will be less than the denominator of 2016-17. And if the denominator is less, the value will be high. The cost will increase. And if the cost will increase, the capital gain will go down. I will solve it with the help of both cases. But now for the purpose of examination, here is a bad news also. If in the examination, it has been given in these 11 cases, that you need to calculate the capital gain and the question is silent, then you need to solve it both ways. You need to solve it as per the provision. In that case, you need to take the index as per assessee. And then you need to solve it showing that as per Manjula J. Shah, the cost will be different. And you have to solve it twice to the examiner to show that yes, you know the both provision. Because this judgment has not been a Supreme Court judgment, so the act has not been amended yet. So in the act, the denominator is still the same, that is assessee. But because the case is in the favor of assessee, so those who want to take the benefit of a previous owner index, they should apply with the Manjula J. Shah case. So it has not been yet amended in the act, so we have to solve it by both ways. So this is the concept which says, in case of the above transaction, cost of acquisition in the hands of transferee shall be the cost of acquisition in the hands of previous owner. That means from the old person, you have to take the cost of acquisition. For short, I have write it like this. Old cost of acquisition means previous owner. For computing the period of holding, old period of holding. That means from previous owner need to be taken. But index should be taken as per the assessee. But other view, which is as per CIT versus Manjula J. Shah, Commissioner of Income Tax versus Manjula J. Shah, Bombay High Court 2011, upheld it. Old cost of acquisition, done. Old period of holding, done. The Manjula J. Shah is only having one difference, that the index of the previous owner need to be taken in the denominator in against as per the act says of assessing. So we have to solve it by both ways. Bombay High Court versus CIT versus Manjula J. Shah, 2011 judgment is here. Where the cost of for which the previous owner acquired the property cannot be ascertained. If it is written in question that the previous owner cost is not ascertained, then we will take the fair market value as his cost of acquisition. This is the only thing we left, of course. The cost of acquisition to the previous owner means the fair market value on the date on which the capital asset become the property of the previous owner. So in these 11 cases, Same concept applicable to calculate the capital gain. We have to solve it twice. Okay. Let me help you with a simple question. So that will be really easy for you to understand. Okay. Let me draft a simple question, very simple question. I will solve it for both ways to you, and then we will go for a break. It will not take more than 5 minutes. Mr. A purchased a building for rupees 10 lakh on 1st April 1998. Its FMV on 1/4/2001 was 15 lakh. This is transferred to his son, Mr. B, on 15th July 2015. The FMV on that date was 90 lakh. Cost of improvement on 10th August 2017 done by Mr. B, 1 lakh. We sold this property on 6th September 2022 for rupees 151 lakh. Commission paid 1 lakh. So we need to calculate the capital gain, and I am showing you to calculate the capital gain by solving with both ways. So we need to find it out. Computation of capital gain. This format need to be used in every question, whatever you solved for house property, PGP, etc. Computation of capital gain for assessment year 23-24 in the hands of assessee का नाम लिखा जाता है हमेशा, that is Mr. B. He sold this property to C, but who is receiving the money is assessee, so Mr. B. So period of holding we need to take from previous owner, that is from Mr. A point of view. So that will be from 98 till 2022. So asset is long-term capital asset. Clear? Now the sale consideration is 151 lakh less expense on transfer, that is 1 lakh. So net sale consideration will be 150. There is nothing difficult. Now we need to deduct the cost of acquisition, that should be index cost of acquisition. For the purpose of cost of acquisition, the cost of acquisition will be as per Mr. A point of view, which is 10 lakh. But because asset is purchased before 1/4/2001, so this or FMV, whichever is higher, will be the cost of acquisition. For our example is 15 lakh into 331. And index as per Act provision, we need to take the index as of Mr. B. So whatever the index of for Mr. B, we have to take it. Let me see the index value for the year in which Mr. B purchased it. B purchased in July 2015. So we want 1516 index value, which is financial year 1516, which is 254. So if we'll solve it, that will come 19.55 approx. If we will deduct it, my long-term capital gain will be 130.45. Just a second. Okay. We just missed one thing. That is 19.55. Now there is a cost of improvement also done by Mr. B that need to be deduct also. Index cost of improvement 1 lakh into 331, and index for 1718 I need. Index for 1718 is 272. So that value will be 1.22. Now 150 minus 19.55 minus 1.22, that will remain 129.23. This is my long-term capital gain as per Act provision. Now in this question, we have to apply also Manjula J. Shah. Let me tell you, it's very easy to apply because there is only one thing we need to change. Only this. This thing we just need to change for the applicability of Manjula J. Shah provision. Only one concept need to be changed. That's one. This says this index need to be changed. So when you are solving in the examination, the everything else will remain the same. The period of holding always be. Now we are solving it as per Manjula J. Shah, but we have to show it both ways. Period of holding always long term, sale consideration will remain the same. So you just need to write it again. That's it. There's no new concept in this. Then less index cost of acquisition, you just need to change one value, and that is index 15 into 331 divided by 100. Because for Mr. A who purchased in 1998, there was no index value. So the concept says purchase index or 2001 to index, whichever is later. So that will come 100. So 15 into 331 divided by 100. Now my cost is, index cost of acquisition is 49.65. And index cost of improvement, that will again remain the same. There will be no change, 1.22. So this will now be total gain is only 99.13. So which is more beneficial to assessee? Always Manjula J. Shah will be more beneficial to the assessee. Always. So that's why for the purpose of examination, you have to solve it both. And let me tell you, you just need to copy every information. Same, just accept this. All the information will remain same. There will be no change in it. So that is the difference. And for 11 cases, the concept will remain same. For example, if I write down, there is a Limited and it's gone into an amalgamation, and amalgamated company is B Limited, and B Limited sold it to a C Limited. This asset has been sold by B to C Limited and asked you to solve the question. Same concept, copy paste. Same. Assessee name will be B Limited. Period of holding will remain the same. Everything else will be as copy paste. There is no difference in all 11 cases. Whether it's gift, whether it is by will, where there is amalgamation, where there is demerger, where you transfer to government, where transfer to anyone. All are same copy paste. There is no difference in the solution pattern. Okay. So we just discussed this provision, and now the break time is there. So we are taking a break, and after break, when we will resume our small story, of course, and then we'll proceed to our numerical, more notes part, etc. So Mr. Ashok, can we go for a break? Okay, welcome back, everyone. So, I'm also back having my tea, and now moving on to our story session. I know some of you must be excited to listen this. I have explained you earlier also that story will just try to make it more interesting your studies. So, and just to motivate you in any manner, if I can. So let's hear a new story. It might be different one. So एक बारी and I told you that story will be in Hindi English both of course. So once upon a time एक बार एक मजदूर था, one worker. उसका काम था कि जो माउंटेन्स होते हैं बड़े बड़े उनको अपने हैमर से वो तोड़ता था वहां से और पत्थर लेकर मार्केट में जाकर बेचता था. His working was this. तो वो एक दिन धूप में आफ्टरनून में एक बहुत बड़ा माउंटेन था, बहुत ह्यूज, उसको अपने हैमर से तोड़ रहा था उसको, और उसके जो जो पार्ट जो मिलता था उसे उसमें से टुकड़े उन्हें अपने पास स्टोर कर रहा था. और जब वो ऐसा कर रहा था तो सनशाइन थी, सन बहुत एक्सट्रीम हीट थी और बहुत उसको भी बहुत गर्मी लग रही. सो ही लुक एट द सन और उसे बहुत गुस्सा है. ही वॉज वेरी एंग्री. तो उसने कहा भगवान से कि भगवान, इंसान होना तो बेकार है, मुझे सूरज बना दो, काश मैं सन होता तो लाइफ मेरी सेट होती. भगवान ने सुना, सन बना दिया. अब वो सन बन गया, काफी खुश, और गर्म हो रहा था और गर्म हो रहा था और गर्मी फैला रहा था, अपना गुस्सा निकाल रहा था. बहुत सारे क्लाउड्स आ गए, बहुत बहुत सारे क्लाउड्स आ गए. क्लाउड्स ने उस पूरे सन को ढक लिया. थंडरस्टॉर्म होने लगा. ही गॉट इरिटेटेड. कहा भगवान, सन बनना तो बहुत ही बेकार, मुझे क्लाउड्स बन. क्लाउड्स बना दिए. क्लाउड्स बनकर वो बड़ा खुश. अब वो सन के चारों तरफ घूम रहा था, थंडर स्टॉर्मिंग, हर जगह बारिश कर रहा था, आवाज कर रहा था, लोग डर रहे थे, एंड ही वाज एंजॉयिंग. फिर बहुत तेज हवा आई, बहुत तेज स्ट्रॉन्ग काइंड ऑफ, एंड क्लाउड्स को कभी यहाँ उड़ा रही थी, कभी वहां ले जा रही थी, और उससे वो फिर से फ्रस्ट्रेटेड हो गया. उसने कहा ये क्लाउड्स बनना कुछ मजे की बात नहीं है, भगवान मुझे हवा बना दो. भगवान ने उसको हवा बना दी. अब वो पावरफुल हो गया, वो यहाँ घूम रहा था, क्लाउड्स को यहाँ उड़ा रहा था, वहां उड़ा रहा था, एंड ही वाज हैप्पी. अब एक बहुत ह्यूज, बहुत सारे पेड़ थे, बहुत सारे, एक बहुत बड़ा जंगल था, बहुत ऊंचे ऊंचे पेड़ थे. वो क्लाउड्स उसको क्रॉस नहीं कर पा रहा था, बहुत ह्यूज ह्यूज. तो उन ट्रीज से, उन जंगल से रिलेटेड हो गया. तो बोला भगवान, क्लाउड बनने में कोई मजा नहीं, मुझे पेड़ बना दो. एंड बताओ तू, पेड़ बना दिया. पेड़ बनकर वो काफी खुश. तो क्लाउड्स से क्रॉस नहीं कर पा रहे थे और इट्स ह्यूज ह्यूज. लेकिन उस पेड़ पे बहुत सारी बर्ड्स आती. बर्ड्स थी, उन्होंने अपना घर बना लिया, वो सब बातें कर रही थी, उसको अपना नेस्ट बनाने के लिए उसको बार बार हिट कर रहे थे. तो वो इरिटेट हो गया फिर से. बोला भगवान, पेड़ बेकार है, यहाँ कभी मेरे पेड़ पे कोई मंकी घूम रहा है, कोई बर्ड्स घूम रही हैं, मुझे बर्ड बना दो, मैं उड़ना चाहता हूँ और मैं जहां चाहे वहां फ्लाई करके आराम से चला दूँ. तो उसे बर्ड बना दिया. नाउ ही वाज फ्लाइंग मजे से, ही वाज एंजॉयिंग हिज लाइफ. अब सामने वही माउंटेन आ गया जिसको वो पहले तोड़ रहा था. ह्यूज माउंटेन था और वो उसको क्रॉस नहीं कर पा रहे. उसकी फ्लाइंग कैपेसिटी इतनी नहीं थी कि इतने ऊंचे माउंटेन को कहीं से भी क्रॉस कर. तो वो अगेन इरिटेट हो गया. उसने कहा बर्ड बनने में कोई मजा नहीं, मुझे माउंटेन बना दो. उसे माउंटेन बना दिया. अब जो माउंटेन बनने के बाद ही वाज वेरी हैप्पी दैट आई एम द स्ट्रॉन्गेस्ट, आई एम द टॉलेस्ट, एंड आई एम ह्यूज एंड दिस एंड दैट. बट उसने नोटिस करा कि उसको दर्द हो रहा था माउंटेन बनने के बाद, बिकॉज बहुत सारे लेबर जो थे, जो लोग, जैसे वो वर्कर था वैसे और भी वर्कर्स थे, वो जगह जगह से अपने हैमर से उसे तोड़ रहे थे. तो उसको पेन हो रहा था, आवाज भी आ रही थी, वापस से इरिटेट हो गया. बोला मुझे हैमर बना दो, हैमर इज बेस्ट. हैमर बना दिया. हैमर बना, उसे लगा ये सबसे अच्छा, अब मैं माउंटेन को भी तोड़ सकता हूँ. अब जब हैमर से माउंटेन को तोड़ते हैं तो चोट हैमर को भी लग रही है. एंड उस हैमर को कोई भी वर्कर कहीं फेंक देता है, कैसे भी कर कर, उसकी कोई मेंटेनेंस नहीं है, तो वो हैमर बन के भी प्रॉब्लम में था. उसने कहा नहीं, इतनी अच्छी लाइफ है इस वर्कर की, ये मुझे कंट्रोल कर सकता है, पेड़ को, पूरे माउंटेन को डिमोलिश कर सकता है, तो मुझे वापस से इंसान बना वापस से इंसान बना दिया. So the process comes, it's a loop. Fine. And if we are not satisfying with our privileges, our attributes, whatever qualities we have, then we are not going to satisfy anywhere. तो प्रॉब्लम किसी की लाइफ में भी, सबकी लाइफ में होती है, एवरीबडी, इवन अंबानीज मस्ट हैव सम प्रॉब्लम, यू हैव सम प्रॉब्लम, माइट भी किसी की ज्यादा है, किसी की कम है, बट टेक्निकली सब लोग अपनी अपनी प्रॉब्लम से फाइट करते हैं. एंड जो भी आपको मिला है, बी थैंकफुल फॉर दैट, बिकॉज कई लोगों को वो भी नहीं मिला है. सो इफ यू थिंक कि मेरी लाइफ में बहुत इश्यूज है, मेरी लाइफ में बहुत प्रॉब्लम है, देन गो एंड फाइंड दोज पीपल जिनकी लाइफ में आपसे भी ज्यादा इश्यू. किसी ने कहा था कि जब वो बहुत डिप्रेस होता है ना और बहुत परेशान होता है, एक पर्सन थे, एक इंटरव्यू में मैंने सुना कि उन्होंने कहा कि जब मैं बहुत परेशान, बहुत डिप्रेस, बहुत फ्रस्ट्रेट होता हूँ, ऐसा लगता है कि मेरी लाइफ बहुत प्रॉब्लम है, तो कहते हैं मैं चला जाता हूँ किसी बड़े हॉस्पिटल के ट्रॉमा सेंटर में, या मैं चला जाता हूँ शमशान घाट पर. जब ट्रॉमा सेंटर जाता हूँ तो देखता हूँ लोग ऑपरेशन के लिए जा रहे हैं, किसी को ये बीमारी है, किसी की लाइफ स्ट्रगल है, कोई वेंटिलेटर पर है, लोग परेशान है. तो मुझे लगता है आई एम बेटर देन देम, मेरी लाइफ उनसे तो कहीं बेटर. व्हेन आई गो टू द शमशान एटसेट्रा, वहां लगता है ये तो चले गए, तो एटलीस्ट आई एम स्टिल अलाइव एंड आई कैन डू समथिंग टू मेक माई लाइफ बेटर. सो वी कैन आस्क गॉड एनीथिंग, बट माइट बी कि जो आप मांग रहे हो ना, शायद आपको उसका वैल्यू नहीं है, और शायद जो आपके पास है आपको उसी की वैल्यू नहीं. माइट बी वो घूम फिर कर शायद यही आपको बेस्ट लगे, बस बिकॉज हमें दूसरों की प्रॉब्लम दिखती नहीं है, इसीलिए मुझे लगता है हमारी ही सबसे बड़ी है. सो जस्ट बी डिटर्मिनेट, बी कॉन्फिडेंट, एंड वॉट एवर क्वालिटी यू हैव, यू शुड possess them. जैसे एक छोटी स्टोरी है ना, वो रैबिट की और टॉर्टोइस की. एक रेस होती है रैबिट और टॉर्टोइस की, उसमें रैबिट सो जाता है और टॉर्टोइस धीरे धीरे चलता है लेकिन जीत जाता है. सो व्हाट इज द मोरल ऑफ द स्टोरी? दैट यू शुड नॉट बी ओवर कॉन्फिडेंट. रैबिट उसमें क्यों हारा था? बिकॉज ही वॉज ओवर कॉन्फिडेंट कि मैं तो इसको हरा ही दूंगा, इजिली हरा, ये तो मुझसे जीत ही नहीं सकता. एंड ही वॉज ओवर कॉन्फिडेंट, सो उसने रेस्ट किया कुछ टाइम. एंड टॉर्टोइस क्यों जीता था? बिकॉज ही डन हिज बेस्ट. उसको पता था कि ये मेरे बस का नहीं है, मैं उसे वैसे नहीं हरा सकता, बट उसने सोचा मैं अपना बेस्ट करता, तो वो उसका बेस्ट था जो उसने किया. एंड फॉर्च्यून्स फेवर द हार्डी, ये सुना होगा आप लोगों ने. किस्मत उन्हीं लोगों का साथ देती है जो हार्ड वर्क, जो कम से कम खुद तो कुछ करते हैं. तो उस स्टोरी से दोनों को एक एक सबक मिला, रैबिट को कि आपको कभी ओवर कॉन्फिडेंट नहीं होना चाहिए. इफ यू आप टॉपर हैं अपने कॉलेज के, अपने स्कूल के, और आप सोचते हैं ये कोर्स मेरे लिए बहुत इजी है, डोंट डू दिस. ओके. एंड अगर आप एक एवरेज स्टूडेंट्स हैं और आपको लगता है ये कोर्स मुझसे नहीं है, तो टॉर्टोइस को सबक ये मिला था कि मुझे या हमें हमेशा बेस्ट अपना करना होता है. एनीथिंग एल्स वो डेस्टिनी पर होता है, हो सकता है हमारे फेवर में हो जाए तो हम वो चीज अचीव कर ले. तो आप अपना बेस्ट कीजिए, बाकी सब जो ऐसा होना है, जो भी होना है वो हो जाए. इस टॉर्टोइस और रैबिट की स्टोरी का एक सेकंड पार्ट भी. रैबिट सीख गया था कि मेरी गलती क्या, उसने कहा दोबारा रेस करते सेकंड टाइम. तो टॉर्टोइस ने सोचा कि पहले भी सो गया था, अभी भी सो जाएगा, बट रैबिट को अपनी वीकनेस पता चल गई. उसने कहा इस बार नहीं सो, यू लर्न फ्रॉम योर मिस्टेक्स, दैट्स द सेकंड पार्ट. नेक्स्ट टाइम रैबिट फटाफट भागा और जीत गया, और टॉर्टोइस हार गया. तो रैबिट ने उसमें सीखा दैट लर्न फ्रॉम योर मिस्टेक्स. सो इफ यू आर नॉट एबल टू क्लियर योर एनी ग्रुप, देन प्लीज लर्न फ्रॉम योर मिस्टेक्स. एंड टॉर्टोइस को ये समझ आया कि हर बार नेवर अंडर एस्टिमेट योर अपोनेंट एवर. अगर वो पहली बार कोई इंसान कोई गलती कर चुका है तो रिपीट करे, कोई जरूरी नहीं. तो टॉर्टोइस को भी कोई सेकंड प्लान रखना चाहिए था, बैकअप प्लान उसने रखा. इसके थर्ड पार्ट में वो प्लान था. थर्ड पार्ट और एक नई स्टोरी अगले सेशन में लेंगे. फाइन. फॉर टाइम बीइंग लेट्स मूव ऑन टू द प्रोविजन. सो वी डिस्कस्ड the 11 capital gain concept of transfer, in which transfer is not regarded as transfer, and in those all 11 cases the solution will be the same. That also we have discussed. Now next is transfer of capital asset under reverse mortgage. So what is reverse mortgage? Reverse mortgage concept is just opposite the mortgage concept, because the name is called reverse mortgage. So what it means, in a general mortgage, what happens if we have a house, we mortgage it For example, its value is 20 lakh and bank provide us 60% value as loan. That means 12 lakh. So what will happen? 12 lakh will be received by us as a loan and we have to repay it by a way of EMI every month. So that is including principal amount and interest also. That is a normal mortgage case, but the reverse mortgage is the reversal of this case. It says now, literally it's reverse. Like if you are building and you're going for a reverse mortgage scheme, the value is 20 lakh, 60% eligibility to take a loan. That means bank is saying we can give you 12 lakh rupees as a loan, but bank is not going to give you this loan in one time. So now loan will be distributed to you as per EMI concept. That means every month 10,000 rupees or as per the decided term will be received by you as a loan. So bank will pay you your loan in EMI. So after certain period of time, it has been distributed. That means if EMI is 10,000 per month, that means in 1 year you will get 1,20,000. And in 10 years, you will get 12 lakh rupees as your loan. So now the loan will be provided as per EMI form and you have to repay it one time. So after completion of 12 year, you have to repay it one time. That 12 lakh plus whatever interest is. For example, interest value is 3 lakhs. So might be you need to pay 15 lakh after completion of a year in a one time. So it's just a reversal. In a normal case, you get the loan amount in lump sum and you have to repay in EMI. Now in the reverse mortgage, you will get the loan in EMI form and you have to pay in lump sum after certain period of time. So you need to repay it either after the completion of time period of the loan term or in the case of death. If the assessee died, then in that case, in that year, you need to repay it. So this loan is only for senior citizen. Reverse mortgage only for senior citizen, husband, wife, both or either of them can claim. So even if the death of the husband, you need not to repay until the death of the wife. So it will continue till the life of both of them. Clear? Now the problem will be after 10 years, this 12 lakh limit will be exhausted. Then how they will survive? So obvious, after 12 years, the property value, which was 20 lakh earlier, will increase. Suppose after 12 years, this 20 lakh value now is 50 lakh. So that means 30 lakh has been increased. So now again this 30 lakh 60%, that means 18 lakh can be sanctioned as loan and can be distributed as per EMI concept. So this is reverse mortgage scheme. Why we are discussing it in capital gain, 12th exempted transfer? Because it says that if you mortgage your building under reverse mortgage scheme. So we are giving our building to bank under reverse mortgage scheme. Then this reverse mortgage will not be treated as a transfer. It will not be a transfer. So no capital gain provision will be applicable at the time of transfer of this case. So this point number 12 is over it. That reverse mortgage will not amount to transfer. Clear? At the time of repayment of that loan, whatever interest will be received by the bank, that is going to be the bank business income. So again, at the time of repayment also, that is no concept of capital gain arise. Clear? If both person died, then bank will resurrender that house to the legal heirs if they want to take it. And if not, then bank can transfer that property or auction that property in the market. In that case, capital gain concept can be arise. So under reverse mortgage, step 1, borrower hypothecate the house to bank, mortgage will not be transferred, so no cap gain. Repayment is installment basis, ownership vests with the borrower, of course. Installment, whatever installment receiving by the borrower, also not regarded as income because they need to repay it. So whatever EMI they are receiving, it's not their income under section 1043, exempted. The property they mortgage, they are not treated as a capital gain. So no treatment at the time of mortgage and receiving EMI. All treatment under income tax will be at the time of repayment of loan or sale of property. If borrower dies, house loan repaid by legal heir, house handed back to the legal heirs, or house sold and loan repaid to bank. If sold by legal heirs, then capital gain provision will apply under section 47. Only interest will be treated as bank income under PGBP head. The concept, the theoretical part of this provision has been written over here. You can read it out. It's very simple, very basic. Next example we can discuss, of course, in which of the following situation capital gain tax liability does not arise. If Mr. A purchased gold in 1970 for 25,000 in the previous year 22-23, his son at the time of marriage, fair market value of the gold on the day the gift was made was 1 lakh. We all know that the gift is exempted. So at the time of gift, there is no concept of applicability of capital gain transfer definition. Next, point number 2, it says a house property is purchased by a Hindu undivided family 1945 for 20,000. It is given to one of the family member in 22-23 at the time of partition. We know at the time of partition, there is no concept of transfer. So again, this is no liability to gain arise. Mr. B purchased 50 convertible debenture for 40,000 in 1995, which are converted into 500 shares. So even conversion of debenture into shares is exempted from capital gain. This will be discussed in point number 13. We discussed till 12 exempted transfer. 13 and 14 is left. So this concept will be discussed in point number 13 on page number 13. So solution is over here. Example regarding the mortgage. Mr. Abhishek, a senior citizen, mortgages residential house with a bank under a notified scheme. So they are asking whether Abhishek is transferring his building under reverse mortgage scheme will be a transfer. The answer is no. This is the solution also, very simple. You need to tell this is true and false. Alienation, that means distribution of a residential house in transaction of reverse mortgage under a scheme made and notified by the central government is treated as transfer. The answer is no. This is false. Zero coupon bonds eligible corporation held for 14 months will be a long-term capital asset. Yes, this is listed security. After 12 months, they become long-term capital asset. So that will be long-term capital asset. Zero coupon. Coupon means in this name interest. So that is without interest. So what is the benefit of these bonds? Because that is issued on the discount and will be redeemed at par, etc. So that difference is going to be your profit, but there will be no interest. That's why it names zero coupon bond. That means zero interest bond. Zero coupon bonds, third case, means a bond on which no payment and benefits are received or receivable before maturity or redemption. The answer is true. All the benefit, etc. will be received at a time of redemption, etc. because there is no coupon involved. That means no interest is involved before the redemption, etc. Okay. This is a definition of amalgamation with the condition also, and this is a definition of demerger with the condition also. And I have told you that if we have left time, I am going to explain the amalgamation and the demerger concept in detail, because amalgamation is simple term. You must have been go through that in earlier year. You must have listened about it, but demerger is a different thing. I'll explain you the meaning if we have time. Do not worry. If we have time today, I have a target of a certain part. If I achieve that target today, so end rest with the time, we are going to discuss the provision of demerger. Do not worry. And if not today, I promise I will discuss into the next session also. So demerged company, resulting company. So 12 capital gain concept of transfer we have discussed. 11 treatment was different. 12 was demerger, reverse mortgage. That's a different concept. There is no concept of taxability. And now 13 point is any transfer by way of conversion of bonds or debenture into the shares or debenture of the same company. So if you have convertible bonds or debenture, and if you convert it into the debenture or shares of the same company, at the time of conversion, there's a transfer because there is an exchange, but there will be no transfer assumed. There will be no capital gain at the time of transfer. Any transfer by way of conversion of preference shares into equity shares of the same company. Also, this is also exempted from the definition of transfer. So technically, if you can think that 11th point we discuss above, And 13 and 14 we are discussing later over here. Why we did not discuss these also with that 11? Because there is a reason behind it. For 11 points, there if the question arises, if the numerical came, then the period of holding concept is from previous owner till now. Then the cost of previous owner will be taken, and the index of the assessee or as per Manjula Jai Shah will be taken. But for 13-14, period of holding and cost of acquisition from previous owner concept does not applicable. There is a different concept in case of these exempted transfers. So that's what I am saying. If those 11 case is in the question, the treatment will be done differently, numerical. And for 13 and 14, the cost of acquisition and the period of holding concept need to be solved separately in a different way. How and why we are going to discuss this with the numerical. Okay. So now we are taking example of conversion of debentures into the bonds, etc. For example, Mr. A purchased convertible debenture 1,000 for rupees 1 lakh on 10th November 2006. And the conversion need to place on 15th May 2018. Suppose, okay? He converted 60% of value into shares. 60% of value of what? This value 60% has been converted into share, and the ratio was 2:1. But for every 2 debentures, you will get 1 share. On 10th December 2022, he sold all debentures and shares at the rate 500 each. So now before solving it, we have to find it out that how many debenture and what is the cost of that debenture remain with this at a time of sale, and how much number of shares and value remain with us at a time of transfer of these shares also. So for this, always solve like this. Write it down, number and value. If you find the right number and the value of both debentures and shares at the time of sale, that means for previous year 22-23. So we have debentures 1,000 debenture, but the value of 60% has been converted into shares. So now only 40% value of debentures will be treated as his cost of acquisition. So earlier we bought 1,000 debenture at the rate of 100 each, that is 1 lakh rupees. But as the 60% value has been converted into shares, so now remaining value will only 40% for this 1,000 number of debentures. So number will not change. The value has been changed. For the purpose of shares, it says for 2 debentures you will get 1 share. So now for if 1,000 debenture was there, number of share will be 500. And what will be the cost? The cost will be 60% because 60% has been converted into the value of shares. So balance will remain the cost of acquisition for the purpose of debentures. Clear? So now we have debenture number 1000 remain, shares 500, value 40,000, value 60,000. So now there are two separate assets. There is no period of holding from old assessee concept applicable, no cost of acquisition of previous owner. That concept is not applicable because owner does not change. In this situation, in case number 1314, owner does not change, asset change. Earlier you have debenture only, now you have debenture plus shares. So now this is simple question. There is no applicability of any special kind of treatment. The special thing is just to find out the new number of both asset and the value. That's it. Now that is a simple question of capital gain. There is no requirement of any special treatment. How it's simple? Because assessee same, there is no assessee change in these kind of conversion question. Mr. A will remain the same. Calculation for assessment year 23-24. We have debentures. We have shares. We have 1000 debenture. We have 500 shares. Now, if I'll ask you to find out the period of holding, so they are two separate normal assets. We have to find out period of holding separately. So debenture was purchased in 2006 and sale 22 because conversion is exempted. That's why in this year we need not to apply any concept of capital gain. So we are applying capital gain in this year directly. So debenture period of holding is long term. Now what is the sale consideration for debenture? 1000 debenture, we sold everything 500 rupees each. So 1000 debenture selling price is 5 lakh less index cost of acquisition. It's a long-term asset, but I have told you in the provision of indexation, there was a note number, I guess the second note was there and it says that no indexation will be applicable. I guess third note was there. It says there is no indexation on bonds and debenture except in capital index bond. And because there is no capital index bond has been written over here. So technically, the indexation concept will not applicable. We just need to reduce the normal cost of acquisition. And what is 40,000 is our normal cost of acquisition in this case. So that will be 4,60,000 long-term capital gain in case of bonds and debenture. Now moving on to our share concept. Shares period of holding, of course, will be taken from the date we got the shares and conversion took place in 2018. So from 18 till 2002, that is long term. Sale consideration will be 500 into 500, that means 2,50,000 less. Now on shares, we will apply index cost of acquisition. So cost of acquisition is my 60,000 upon 331. There is no Manjula J Shah concept applicable. Simple. You got the Manjula J Shah is applicable when there are two assessee cases in those 11 cases. There is no new assessee. So the asset purchase in 1819 conversion. So we will put 1819 index over here, deduct it, and that will be our long-term capital gain or loss, whatever it will be. That will be my answer. So in case of point number 13 and 14, there is no special concept of calculation. There is normal provision. You just need to find out the new number of debenture and its value after conversion, and again the number of shares and the value after conversion. After that, it will be a normal questions. So this is clarification. The cost of acquisition of shares or debenture received on such conversion shall be that part of the cost debenture or bond which is so converted. That is new cost. Period of holding, normal period of holding will be applicable. If preference share converted into bonds or debenture amount to transfer and capital gain will arise. So conversion of preference share into equity is exempted, but if preference shares is converted into bonds or debenture, then it's going to be taxable in the same year. There is no exemption for that. So these exempted transfer concept has been given. Exempted transfer concept has been discussed. And now moving on to our new concept of advance money forfeited. Let me take the query. What are you asking? Okay, so Mohammed K is asking, I have a doubt regarding TGBP, a hire vendor doing business of sale of some asset on hire purchase basis. In that case, hire purchaser will become owner only when the last installment is paid. Till then, hire vendor claimed the depreciation section 32 as he owned and started to put use. Can hire purchaser able to claim depreciation on the same asset if he had used the asset in business? Only one person can claim the depreciation, of course. If the hire vendor is claiming the depreciation, then you cannot claim the depreciation. Otherwise, it will be a two-way benefit. Only one way benefit is allowed in case of income tax. Two-person cannot claim the same benefit. And we need to see the contract also before doing this. Okay, next is Bhumika is asking, sir, if there is any maximum time limit of repayment of mortgage by borrower? It will depend upon the bank policy. So there must be some bank policy for the mortgage time period. It will be given in question. That is not the income tax concern. What is the time period, etc.? It can be different policies as per the different bank. Okay. Next is Vaishali is saying, ratio is given. Yes, in the question, the ratio and the percentage value which is going to be converted, like 60%, etc., that will be given in question. Vaishali is asking, sir, please once more in shares conversion. Vaishali, we are on, of course, taking a virtual class. You need not to ask for again because you can scroll back and watch it as many times as you can. Conversion concept slightly tricky, so might be you're not getting it with the class because we are explaining the provision as well as we are implementing it. So after the class, you can scroll back, you can watch it once or twice, you will get it. It's very simple. It's pure mathematics. There is no income tax concept in conversion because you just need to find out the new shares and the value. After that, the question is a normal question. There is no special treatment involved. Even after that, if you watch this class again or your concept again, if there is any problem, let me know. I will tell you in the next session again. Okay. So now the advance money forfeited under section 51. Now the concept says there was technically two treatment of advance money forfeited. What is the concept of advance money forfeited? Let me discuss it with you first. Then we will see what is the treatment under capital gain act. It's a very simple thing. Generally, when we deal in land and building, for example, Mr. Iron Man, he is transferring his land and building to Mr. Superman. In generally, land and building contract, there is a registered deed happen, registered agreement we can say. And there must be some advance money which need to be paid by the buyer at a time of registered agreement. For example, he wants to sell this property for 100 lakh and Mr. Superman gave him 10 lakh rupees in advance and said that he will pay the balance money within 3 months. And it has been written in the deed. And Mr. Superman, if he is not able to pay this money, balance amount, then this 10 lakh will going to be forfeited by Mr. Iron Man. That has been also be written in the agreement. So the same thing happened. Mr. Superman was not able to provide the balance amount. So Mr. Iron Man technically forfeited it. So this amount is called advance money forfeited. Clear? So this 10 lakh has been forfeited by Iron Man. Now the concept says before 1/4/2014, the concept was different, so we are not going to discuss it. On or after 1/4/2014, now the provision says if any advance money has been forfeited by the assessee, then that amount of going to be taxable as his income from other source in the same previous year in which the advance money has been forfeited. So it's a simple concept. there is no treatment in capital gain. The advance money forfeited by the assessee is going to be taxable under income from other source in the year in which such amount has been forfeited. Simple provision, very simple. So if any advance money is forfeited by the assessee or any person, then the amount so forfeited will be treated as income from other source in the year in which such amount is forfeited, if on or after 1/4/2004. So what was before 1/4/2004? That need not to be understood because that's the old provision. We should skip it. If advance money received and forfeited on or after 1/4/2014, then advance money forfeited will be tagged under section 56 to 9 as income from other source. Tax liability attracted in the year of forfeiture of advance. That was advance money forfeited provision. Now the provisions are very simple and very small actually. Separate, small provision. The huge provision was transfer. The huge provision was cost of acquisition calculation, etc. I have made the diagram for each and every provision almost. I will upload them today also. Do not worry. But even in notes, I try to frame like this. So you will be able to understand. That is self-explanatory notes. So I try to explain the notes. So you can see the notes, read it, and you can understand the treatment also. So now we are going to understand the treatment of transfer of capital asset by a partner to the partnership firm, and if a partnership firm transfer it to the partner. So there is only one concept we need to understand in this case, and that is how to determine the sale consideration in these two cases. So we are finding sales consideration. So sales consideration in two cases. Period of holding, cost, etc. Same concept applicable. We just need to find what should be the sale consideration in these two separate cases. One is when a partner transfer his asset to partnership firm. Section 45, subsection 3. What will be the sale consideration? So the provision says if any partner transfer his capital asset to the partnership firm, then for the purpose of partner, we need to calculate the capital gain. Capital gain in the hands of partner. For that, period of holding will be taken as normal provision. The problem is what should be the sale consideration. So it's a very simple concept. The book value recorded in the books of firm for that asset will be called your sale consideration. For example, partner transfer an asset to the firm for and the firm recorded books in the 10 lakh rupees. The fair market value of this asset was 12 lakh rupees. So what will be the sale consideration? That will be 10 lakh rupees. Just that. The cost or index cost depend on the nature. Cost of improvement, index cost of improvement, normal provision. There is no new concept. Section 45(3) just deal. Then when you transfer your capital asset to the firm, so what amount should be treated as your sale consideration? The answer is book value as recorded in the books of the firm. And what will be happen in vice versa case? If partnership firm transfer any asset to partner, then under section 45(4), what will be sale consideration? It's very simple. That is fair market value. So sale consideration in this case will be fair market value. For example, partnership firm transfer an asset to a partner whose book value was 5 lakh, but the fair market value was 12 lakh, and the consideration charged from the partner was 6 lakh. So in that case, we will take sale consideration as our fair market value. That fair market value will be your sale consideration. The cost, the period of holding, indexation, etc., that will be all applicable as per normal case. So this is very, very, very easy concept. So book value or amount recorded in the books of the firm, that will be your sale consideration, of course, cost, etc. having same provision. At section 45(4), it says sale consideration will be the fair market value of the asset. General provision under capital gain, section 45, it says that if there is a capital asset and if there is a transfer, if there is a capital asset and if there is a transfer, then the capital gain will be chargeable in the year in which transfer took place. For example, if I sell my asset in this year, capital gain will charge in this year. So in which year the transfer took place, that will be technically going to be the year in which we are going to calculate the capital gain. So any profit and gain arising from the transfer of a capital asset, charging section condition, effected in the previous year, shall be chargeable to income tax in the previous year. So this is the basic, or we can say this is a general provision, that capital gain will be chargeable in the year in which transfer took place, but there are some exceptions. There are some exceptions, and those exceptions we are reading in this section 45(1). So these are technically not exceptions. These are the genuine cases, we can say. There are certain cases in which technically we do not get the amount in the year of transfer took place. So in those cases, government say yes, transfer is happened in this year, but because no money received practically in this year by the assessee. So how he will be able to pay the tax if he does not receive the money? So the chargeability has been deferred for that year in which he is going to receive the money practically. So when we will going to read the exception, you will understand that this exception was mandatory. Otherwise, assessee was really in trouble because he won't be able to pay the tax because he is not going to receive the money in the year of transfer. He will get that money in other year as per the situation of the case. First one is conversion of capital asset into stock in trade. When I will explain you this with an example, you will get to know what exactly is the provision, why it has been made, and it's a genuine provision for the benefit of assessee. So if you are having a capital asset and you are converting that capital asset into your stock in trade in this year, you must be remember that was in the definition of transfer also. And I told you that we will discuss conversion of capital asset into stock and trade provision in detail later, and compulsory acquisition also, section 45(5). That also we'll be discussing under this section only. So those are the cases in which transfer assumed in the year transfer took place, but chargeability of capital gain is deferred for the year in which you receive the amount. For example, if our asset destroyed due to fire, we are having a building in which we reside, we insured that building, and fire took place or earthquake came or any kind of destruction happened. So our building collapsed. But when we file the insurance claim, so destruction of asset is a transfer. And if in the previous year building collapsed or destroyed by fire or by any other reason, so in previous year 22-23, it comes under the definition of transfer. We filed a claim for insurance compensation, and insurance compensation is received after 2 years. Generally, of course, insurance compensation does not receive so early. So technically, it will be received in later year. And if government asks that you need to pay the tax in this year due to transfer has been conducted in current year. So how assessee will be able to pay tax? Because he can only pay the tax, if any, in this situation, in the year in which he received the amount of compensation. So that's why that case also included in these points. So we have 5-6 cases in special cases in which technically amount received after some year. So chargeability will be in that year, but all the provision will be applicable in the year in which transfer took place. That's the same case with the case of conversion of capital asset into stock and trade. Let me explain you with the help of example. Okay. So what I am going to teach you in conversion of capital asset into stock in trade, that is going to be applicable in almost all cases under this section. Suppose there is, after this example, I will take the queries if there is any, and then we will wind up our class because it's already 9:42. So for this example, I need only 5 minutes. There is Mr. X. He bought 2 buildings on same date, 2nd of April 2010 for rupees 10 lakh each. Now he becomes a builder. So this is his capital asset now. Fine. Now he start a business of being a builder and start selling and purchasing buildings. So he thought, this is my capital asset. Why should not I use them as in my stock in trade? So he converted these capital asset into his stock in trade for this builder business. And this has been done on 21st of January 2016. At that time, the fair market value of these assets were 40 lakhs each. Now, because conversion took place in this year, so that is called a transfer. So technically, we should charge capital gain in this year. And if in working, I'll need to show you, it's a general thing that FMV is 40 lakh will be treated as sale consideration. So FMV is 40 lakh for each. So technically we can say the sale consideration will be 80 lakh. And if we are not doing index cost of acquisition, I'm just showing you a simple calculation. Then 20 lakh will be the cost of acquisition. Almost 60 lakh will be your gain. That will be chargeable to tax around 20% of tax rate. So approximate 12 lakh will be your tax liability if this provision has not been in place. If there is no section 45(1), then as per the provision of transfer definition, government will assume your transfer took place in this previous year. That means previous year 15-16, and they will charge capital gain in assessment year 16-17, and department will ask at least 12 lakh as your income tax liability. So because you can understand, we just converted our asset into stock in trade, but we did not receive any actual money. So how assessee will be able to pay this 12 lakh rupees of tax? Because we just changed the balance sheet head. Till now, it was as a capital asset or fixed assets in our balance sheet. Now it is in the stock and trade column. That's it. So being conversion is just change the value and the position in the balance sheet. But practically, he did not receive any amount. So how he will be able to pay the tax of 12 lakh rupees if this section has not been in place? So government understood this problem and say, yes, you are correct. So in this situation, when you converted your capital asset into stock in trade, government understood that at the time of conversion, there is no actual money flow. So he cannot be able, he won't be able to pay tax on it. So they deferred their tax liability in the year in which stock in trade has been sold. So government will charge their capital gain in the year in which stock in trade is sold. For example, stock in trade has been sold on 5th of November 2022. Both buildings has been sold for 70 lakh each. So now for assessment year 23-24, we charge capital gain. So for this year, we just need to calculate the capital gain, but all the provision will be applicable till this date because transfer took place over here. And technically, capital gain should arise in the assessment year 16-17, but because you do not have any money, So now they are just going to charge that capital gain assessment year 23-24. But all the concept will be applicable by assuming that asset has been sold in 2016, so that the period of holding will be taken from 2010-2016 only. We just need year for this calculation, just the year. Just year will be taken from this value. All other values, all other treatment will be as per 2016 transfer, etc. So now the sale consideration you can see as per FMV will be treated as your sale consideration. So this will not be our sale consideration because this is the sale consideration of stock. We need to take the sale consideration of capital assets. So if we do not converted it, these capital asset into stock, and we are going to sell it into the market, then what must be the sale consideration? 40. So we will take the sale consideration as per the FMV at the time of conversion will be my sale consideration, less index cost of acquisition. See carefully. The cost is 20. And now the transfer year index need to be taken in the nominator. And because we always take 331 in all questions, so student may in hurry can take 331 over here also. That will be a wrong thing because we need transfer year index over here. And in this question, transfer year is not this. This is the stock in trade transfer. Transfer year is this. So we need to take the financial year 15-16 index in the nominator. Always remember in these kind of section, the mistake we generally do that we generally write it down 331 because it's a habit that we always use 331 in the nominator. So in these kind of cases where the chargeability year is different and the transfer year is different, we need to take the transfer year index as per the formula, which says in the year in which asset has transferred. So we need to put it over here, the transfer year index, which will be given in the question. And purchase year was 1011. So there will be 1011 index. That will be my index cost of acquisition. And that will be my long-term capital gain. But because we sell the stock, so question or examiner will also ask, calculate my PGBP income also for the same year. Because we technically find out the capital gain income, not the PGBP. So we have to calculate the PGBP income also for this question. It's very, very simple. So what is the sale price of stock? That is 140. 70 lakh each. So we sold 140 lakh rupees stock. And what is the cost? It's very, very simple. What is the sale consideration under capital gain will be the cost for the PGBP. The FMV will be treated as sale consideration for the purpose of capital gain, and the same FMV will be treated as cost or purchase price for the purpose of PGBP. So 60 lakh will be my PGBP income in this question, and this capital gain, whatever it will come, will be my capital gain income under this question. So remember, in case of conversion, transfer year will remain the same, just the chargeability year change. Chargeability year will be that year in which stock in trade has been sold. So in that year, we need to calculate as per the provision, assuming if it would have been transfer in the year 16, 17, then what will happen? So the period of holding will become the normal period of holding. Sale consideration will be the FMV. Cost will be normal provision. Whatever your sale consideration will become the purchase price or cost for the business head. And this will be my sale consideration for business. This 60 is my PGBP income. So it's very interesting. So these are the provision that says regarding this, any stock in trade has been converted. A person who is the owner of a capital asset may convert the same or treat it as stock in trade in the business carried on by him. As noted above, the above transfer is a transfer. But income will be taxable in the year in which stock has been transferred. In that year, we need to calculate the PGBP income as well as the capital gain. What is the consideration? The fair market value at the time of conversion will be treated as is sale consideration. And that conversion fair market value will become the cost for the purpose of stock solution. Here is the simple solution format for you to understand how to solve this kind of question that I just showed you with the help of an example. Illustration 1. A is the owner of a car. On 1/4/2020, he started a business of purchase and sale of motor car. So car was his asset. He transferred or converted that into his stock in trade. He treat the above car as a part of stock in trade of his new business. He sell the same car on 31st March 23 and get a profit of 1 lakh. Discuss the tax implication. There will be no capital gain because car is a mobile asset and personal also. So there will be no capital gain chargeability in this case. You can solve illustration number 2 yourself. It's very simple. Already solution has been given down. And example 3. Okay, fine. I'll help you in solving. So we are technically completed till page number 8. I had a target to complete it till page number 22, but we are short of 4 pages. So demerger definition will be discussed by me in the next session. I will complete this whole assignment in the next session, third session, because we have second part also remaining with us. So for 3 sessions, we will complete the part 1, what I have uploaded, and the part 2 notes I will upload after our third session. So we will have 2 sessions for the numerical problems of your study, for part 2 exemptions, for calculation of tax provision, etc. Okay. So, okay. So not much left. We will discuss these provision. Let me see that there is any query regarding it. Okay. This Bhumika, it's study material. It says gift of shares or debts, debenture allotted ESOP is it is transfer, but it's not taxable. It's gifted. Gift is exempted. You're talking about this, okay? So it's a transfer. Everything is a transfer, but it's chargeable to tax or not, that matter. Privati Satya Lakshmi Sai Kumar. My God. Sir, I have a doubt in this chapter. Assessee sell house to one person before selling house. He do painting for house and repair expenses incurred. The expenses amount in total 150, such as painting experience 130 and repairing is for 20. For computing capital gain, these 2 expenses treat as selling expenses or cost of improvement. To explain the treatment for 2 expenses. These expenses are not going to be treated as your cost of improvement expenses because they are in revenue nature. They are not capital nature. The second question is these expenses will be treated as your transfer expenses. No, transfer expenses will be flow to some other person. If we are selling something and the brokerage commission etc. is going to some other person, that is an expense of transfer. Understood? Whatever you have done with the painting and renovation etc. repair, so you must have add this expenditure from the sale consideration automatically. If I'm going to sell my property for 50 lakh, but if I have done some repair etc. for 1 lakh and 50,000, so now I will sell it for 51.50 lakh generally, practically. But in your question, let me tell you, these are not going to be the transfer expenses, nor they will be considered as cost of improvement, because for cost of improvement, that must be capital nature. For expense on transfer, your expenditure must be flow to some other person. So there is, and that is at the time of commission, brokerage, etc. Repair and etc. These expenditure cannot be part of your this concept. That will have no treatment over here. So we have done with today's session. All the best. Please do read your provision, revise twice. That's my advice to make you wise. And in the third session, when we will join again, we will complete our part 1 provisions. And with MCQs, we have left 3 MCQs regarding the Manjula J Shah cases. So in the start of class, we will take that 3 MCQs and more MCQs before starting of the class. So please join live classes and take care and study hard. See you on now, I guess, Monday. That is 17th of July. So, Ashok ji, can we conclude the class?